Welcome to episode 198 of the podcast. I'm Jace. I'm here with Nick and Marty. What's happening today, guys? We well?
Yeah, going well, Jace. Excited. I think things are turning in regards to rates might be coming down the track, and I'm excited about that. And I'll talk a little bit more about investing in this podcast. Nick, how are you?
Good, mate. How long's the track?
Yeah, I think US are going to cut rates in September, so I'm happy about that because that just means that it's a little bit easier for us to release. But what I've seen just recently is one of the major banks cut their 3-year fixed rate on investment down from 6.59 to 5.99. So that's always a good sign when the 3-year fixed rates start to decline, and it also provides opportunities in the market for people just to secure better rates. So that's the first time I've seen the majors do that. I've seen a couple of the smaller banks do that, but it's a good sign with the majors. And I think the other thing that's come out in the news is that the mortgage arrears rates are up to 1%, which is still very, very healthy. It means 99% of the market are meeting their repayments, but just declining real wages, rising unemployment, you've got CPI, consumer spending's down, and now those arrears rates coming up a little bit more is a really good factor as well. So that's another signal that we could be getting some decent times ahead on rates. And the other thing, the third factor, is that housing price growth has plateaued just in the last month. So it's been increasing by about 0.7% month on month, and that's now down to around about 0.3%. So this is a good sign because there was limited stock on the market, but still getting, properties that were built with nothing to do, we're still getting exponential prices on those properties. So the pullback in that area is actually quite good as well. So from what I'm seeing, I just feel like we're not too far away. We're in the home stretch, and it'll still be 2025, but it gives me confidence that we're not going to see a rate rise, which is no one wants that, and that we're heading into better times ahead. So does any of that info resonate? You happy about that?
It resonates. Can I ask you a big question off the bat?
Yeah.
Do you think we'll go into recession?
Well, I think the US are very nervous, very, very nervous. In fact, they need to cut rates sooner rather than later based on their data. I think we're a bit more robust in Australia. So I'm not sure. I think there's a people recession, but commercially on the historic numbers, that's not showing up yet. But I feel like when you're on the ground talking to everyday people, it's certainly tighter, and people are certainly, tightening the belts, and they have been for a while. But it's getting to the point where it's having an impact, and declining wages is not only unemployment, but declining wages is a concern when it links into consumer spending as well. So to me, I'm not sure if I can answer that we'll end up in a recession, but we have to. They'll have to monitor it so we don't. So I don't think we will.
Does it really matter if we go into a recession?
Well, I don't think so. I think
gives the media something to do.
Yeah, I think at the end of the day,
it's just numbers, right?
Yeah, I think at the end of the day, a little bit of declining growth. I know on a macro level that means a lot, but I'm always of the opinion that if you're good at what you do, you can actually, you can actually do more in challenging markets. And so to me, it's more about, I've always been one to see it as a great opportunity because, the rest of the market can be challenged, and it's a chance to step up and do very well in any market. So I think it actually, it sounds terrible, no, but I kind of get a little bit excited because I think we can actually have a bigger point of difference in these markets when we do what we do well. And I think business owners that are doing well in these times would feel the same, no doubt. So to me, yes, it's just a high level read, but does it affect you in a smaller business? Probably some more than others, yes, but I think you can always find a way, always. Did I answer that question?
You did. Okay, that's you've hit some big stuff up front, Marty. So you've got a lot lots to deliver on now. I'm excited.
Yeah, well, I think today I wanted to talk about specifically the rise of private credit in Australia and the potential competitive threat to Australian banks. And just to give you a little bit of an do you know what private credit is? Have you come across that before, Jace? You would have seen it somewhere.
Yep, definitely. And sometimes it scares me when clients come to me and it's already locked and loaded and in place, and we haven't had a chance to see if there was, other options, or to make sure that, all the documents I's are dotted, T's are crossed, and that there's actually, there's some stuff behind it. Yeah, sometimes you see some sharks out there. But anyway, I'm excited to unpack it in more detail than my loose description.
Yeah, well, you're on point. Like, there was a time going back 20, 30 years ago that if you were asset rich and you had a great relationship with the bank managers, that you could find a way to take on opportunity, right? It was an unregulated environment. Doesn't mean it was right, but it was unregulated, and there were a lot of moving parts that could happen within the banking system. Nowadays, things are much more regulated, and a lot of I's need to be dotted, and a lot of ticks need to happen for things to go through, and that's okay. We want that to happen. But what we're seeing is this massive rise in private lending happening, and sometimes backed by family funds, sometimes backed by companies raising money from investors, and it is generally more expensive. And the difference between private credit is if you've got an asset and you're not showing cash flows like usual, like whether it's pay cash flow or whether it's business returns that the banks would want to see, there's still an opportunity to be able to access funds if you want to take on an opportunity. The difference is you need a clear exit strategy on the funds. So, for example, let's say someone's asset rich, they've got a property worth $1 million, they want to buy a business, and the business isn't showing returns. In fact, it's probably got a slight loss, but the person sees it as a great opportunity given their background to take that business and make it profitable. So generally the banks are not going to want to do that if that business isn't as healthy as they would want to see. But because you've got so much equity, you could actually go and buy that business as long as there's a clear exit strategy after 2, sometimes 3 years. And an exit strategy in that situation would be you're going to build that into a profitable business over that time, and then go to a major bank or a second tier lender, whatever the case may be, so you can transition out of that opportunity. Someone sees a great commercial property they want to buy under the same premise, and they go, all right, well, the numbers aren't stacking up, but they know that there's 40% upside for whatever reason in the next 12 months, and they want to take advantage of the opportunity. So again, it would be a very small percentage of the market, you would think, but it's growing. And the cost of private lending is generally 2 to 3% more expensive on interest rate. But when you're looking at the opportunity cost of getting into something is going to make money, sometimes people want to take on that opportunity at a higher interest rate in order to secure it. Nick, have you come across this at all?
Well, yeah, and it's opportunity cost. And when you're looking at these types of funding, it's generally for commercial reasons and businesses. And you just factor the interest rate in as a cost to doing business. So, hypothetically, I'm just picking numbers here, but like we see a lot of property developers do it. You factor the interest in because banks are just way too difficult. So, if you're $1 million in profit, you've got lending fees of $250, so you're $750,000. Does that still make sense? Well, I guess depending on the outlay, yes. You're still making $750K versus making nothing. So yeah, I think you accept it for what it is, as in it's a little bit higher in interest because they are asking less questions, which means the lender is definitely bearing more risk. But as long as those numbers work into your over profitability of the transaction or what you're trying to achieve, it's just the cost of doing business. So we see it a lot.
Yeah. And the increase is in private lending activity, 16% year on year increase. So you can see that people are looking for opportunities to fund opportunity, which is really important. And they say, according to BlackRock, Australia's market is estimated at 188 billion in regards to private funding out there at the moment. And the US, just to give you a comparison, is 1.6 trillion under private funding. So it just goes to show you big short, big short, big short. but it just goes to show you that the opportunity for growth in this space is there, and investors actually putting their money towards private funding are getting decent returns off it as well. And I think the major cost difference is probably the initial costing to get into it. Like if you went to a bank on, let's say, $1 million of commercial lending, they generally charge you around about a 0.5 establishment fee. So it's roughly around about 5,000. But on a private lend, that can be from anywhere between 1.5 to 2%. So again, you're paying 20,000 up front. But like Nick was saying, you've got to look at the opportunity cost. A lot of times people get into this and have huge upside.
It's a good point. And I think what people need to remember is it's a quick transaction. It's generally an in and out transaction. It might be for
Correct.
1 to 2 years. So I think what I've seen in the past is people coming in that want that lending, and they'll say, oh, it's a 1 to 2% establishment fee, or the application fees are too high. What people need to understand as the borrower is it's not a 30-year loan. You're in and out of that transaction. So they're actually not really going to make the money out of you from an interest rate point of view. You're not there long enough. So as the borrower, you need to remember that they're not a bank, and they're treating their lending as a business as well. So if they're giving you the money, they need to get a certain return. Otherwise, they'll go somewhere else for the return because there's other places they can go. So, don't be scared away from establishment fees because you're in and out of that transaction. It's very quick. So generally, they're not making the long-term interest component like a bank would.
And you make a great point, Nick. The major lenders and just general lenders can take 4 to 6 weeks on property deals sometimes, whereas here on a private lend you can turn that around in a week in some situations. So again, must have an exit strategy. That's the main point you need to be able to communicate to lenders. The other thing is you can capitalize the interest repayments if you have enough security. So the thresholds usually against residential property are around about 70 to 80% that you could borrow up to on a straight lend, and commercials around that 60, 65%. And there's a lot of private funders out there now, and where it's important to come to a broker is to be able to decipher between what Jace was saying is it can get very sharky out there, and to make sure you're dealing with legitimately good organisations where you're accessing your money from. And there are, the general mainstream media will say it's all sharky, but there are some really good businesses out there doing great things for clients, and it's really important to take note of that.
Yeah, and that's a really good point, Marty, because without the knowledge, how do you know? So where the sharks do circle, I guess, is when things do go off track a little bit. So if there's, you talked about an exit strategy, highly important to protect yourself to get out of that funding. But sometimes that doesn't happen. And sometimes it can be reasons outside of your control. So where the sharkiness comes in is how do those lenders react in that situation? And there are some lenders out there that will see that as an opportunity, that you haven't met your your contract obligations, and they'll see that as an opportunity to swoop and take as much from you as they can. So I think dealing with a broker that's got history with a lender, has seen lenders in those situations, understands how the lender reacts in those situations, is absolutely paramount when you're jumping into this funding. You need to make sure that you're dealing with a good organisation that's going to be reasonable if things happen outside of your control, to find a solution that's good for everyone. Highly important.
Yeah, you want those organisations to be thinking more in bank terms in regards to that back end. So if something does go wrong, it doesn't go very, very wrong because, as we say, the sharky ones want you actually to default and then take the asset. So, or have costs, heavy costs where they make even more money. So the good ones, really make sure that there's not that expanded contagion of it getting from bad to worse. So really important, and even to be able to capitalize the interest repayments over that period of time of the 1 or 2 years, like. And Jason, in businesses as well, if people take on, let's say they're taking on a slightly underperforming business, but they've got the acumen to build that around, it can really help having those interest payments sort of catered for in the first, let's say, 12 months while they really expand that upside. The same if they're buying a property that they want to improve upon, and then the exit is to sell that property in 18 months' time, then they don't have the heartache of having to find that capital to pay back the debt. Now, of course, that's more costly to be able to do that when you're capitalizing the interest naturally. But if that's all budgeted for and the upside is there, it can be very beneficial. And you would see people wanting to do that if they were buying a business just in general anyway, a lot of the times in that first year.
And that's what you think about, the word capitalize. If you've got the right mindset that you're working on building a capital asset, you're adding capital, you're adding asset value, then it makes sense that, again, to your point, the exit strategy a couple of years later, if you're able to turn that asset into cash, pay back the lender, and there's a win-win for everyone involved. And, touched on it earlier when Nick said that person's running a business as well. They're in it to make money. And there's a higher risk factor by doing private lending for everyone involved. So that higher risk factor means a higher interest rate. That means it needs to be more wins for everybody involved. So if you are the person looking to take out money from a private lender, you've got to have your ducks lined up. You've got to be working with a good advisor or a team of advisors that know the risks that you're getting into. And it's also about mapping out the what if scenarios. What if the property you're developing doesn't sell for X dollars? What if you need to hold it for an extra 6 months? What happens if, X, Y, Z? So it's all mapping out multiple scenarios to go, am I comfortable with all of these potential outcomes? And if everyone's comfortable, go and get the money and crack into that project, whether it's the property development or buying the new business or adding the extra business to your existing. They're all things that, are great examples of how to use private lending. Just got to make sure you map out all the scenarios.
Project-based. Be very project-based and see that project as a business within itself. I think if you're doing it that way, you've done your budgeting around it, you've got your outcomes. And if something does go amiss, let's say you've got a term of 18 months, you can renew it as long as you're being proactive as well. Not that you would want to, but you can look to extend as long as you're proactive in your dealings with the private lender. So it's not the end of the road, but you want to be really clear on your exits wherever possible, because it then can start to bank up. And it's interesting because the banks know that this is happening and there's a space for it, and they are trying to come back with their own opportunities, but not quite as aggressive as well. So you're seeing you're seeing a lot of different parameters around commercial lending in the general market, like particularly under that 2 million of lending space. For instance, in some situations, they will look at lending under 2 million. You can have one BAS and they'll annualize that BAS and take 40%, 30 to 40% of the revenues as income to service that debt when someone's looking to purchase a property. Now, even though that can be utilized, you still have to be in a disciplined decision in your own business to go, can I afford that? But it's really interesting that you can see flexibility. Like the other day, I had a lender that says we don't do unsecured lending in the commercial space, but then under 2 mil. And then they said, but what we will do is we will leverage up to 140% of the residential property, or we'll do 120% on the commercial property. So we don't want to do pure unsecured lending where we're not putting up any assets, but we will take an asset and leverage out, because they see a real opportunity for people to progress forward as long as the lenders have some form of property backing on it under 2 mil. Over 2 mil, you can do cash flow lens. You've got criteria around that as well. But that under 2 mil space, there's a lot of flexibility where I think the lenders think they can really compete at that next level under private lending, under private credit. So I think both can work in coexistence, but it's interesting to see how the different types of parameters that are coming out around that. So you still got to do your own due diligence though, because just because you can get money doesn't mean you should. You would see that, Jace, wouldn't you?
Yeah, 100%. And again, I think we've touched on it time and time again, but another reminder that before you go and get money from anyone, talk to a professional, talk to a finance broker, talk to your accountant. Sometimes there's hidden things that you don't see. You can get excited by the money up front or the project or the plan you're going to do or how it's going to solve a problem, this week or next week in your business. But think long term and think about all the different things that can happen. Talk to a professional first. Because unfortunately, while these loans and short-term lending can be a great mechanism to solve a problem and to help get from A to B, there's often things that you don't take into consideration which cause absolute havoc on the other side. And we've seen good businesses go into liquidation due to getting involved or potential liquidation. I've seen businesses go under through doing these things. I've seen everyday investors that have got involved in some private lending on the other side as well. So there are a lot of traps that you can get yourself into. So having a good team of people in your corner is always important as ever.
And they will take your asset. At the end of the day, if you don't perform and work with them on the exit, you're at the you're vulnerable. You're vulnerable, and you don't want to place yourself in that position. Now, this would be I would say we might see 5 of these a year, but I'm maybe a little bit more in the last couple of years with the restrictions on lenders. But it certainly is a growing area. And it is a solution to an opportunity rather than it can be a solution to a problem, but it's better when it's a solution to an opportunity. And what you want to exhaust is every other avenue that is mainstream that you might be able to get on a better rate. And that's, that would always be the first point of call, is to secure, a mainstream position, and it really only be, a back end consideration type of thing. So I hope that gives people some understanding of what's going on, how it's going on, and some alternatives out there as well.
Well, I think anytime there's, 16% year-on-year growth, there's attraction to the market. It's a solution. And as you said, banks make it so damn difficult. And if anything, the turnaround time where I've seen this work really well is the turnaround time for banks is months and months and months of due diligence and document collection and dot I's and cross T's and back and forward. Whereas I've seen some private lending get done really, really fast. Super fast. So, if you need a quick solution, you've got an opportunity that pops up, let's say, because these things happen at barbecues where somebody will go, geez, I've got this opportunity to get this property and I reckon we could do this on it. And then you go, it takes too long to go through a bank and get that done. But where I've seen great operators who have who know about private lending, use it to their advantage, is when an opportunity comes across their desk, they're not waiting around going, oh, we can't do it in this short time frame because of the banks. They're going, let's get the short-term funding dialed and sorted real fast, and we'll refinance down the track. Or if it's a good enough rate and you've structured it right, you can use private lending to your advantage and make some serious money along the way.
Well, sometimes, Jace, you make a great point. You have someone going to private lending and they have, on a business acquisition, and 2 months of good performance and a cash flow forecast, and you transition straight out into mainstream. So it doesn't have to be a long time. It just serves a purpose for the greater opportunity in the end.
Absolutely love it. Well, if this has got your attention and you're interested in talking about private lending, I'm just going to throw this out there and say that, Marty, you would be the absolute go-to, that if any of our listeners have got, their juices flowing, creative juices flowing when it comes to, wanting to kick off a project, buy a business, do a property development, never thought it was going to be possible, should they be coming to talk to you, Marty?
Well, yep. I'm glad you got the juices flowing, and hopefully the audience have. Absolutely, they can. And like I said, I'll always look at it fundamentally from a mainstream first, but depends on the situation. And we've got a lot of ways we can support business owners out there in many different terms.
No, 100%. Well, appreciate you sharing this one, Marty. It's been an interesting one, and it might be something that a lot of our listeners have never thought of that they could get access to. So check out our YouTube channel where you can see Marty's beautiful face, and then Nick and I just adding, off to the side here. We'd love to have you as a follower. Give us a like, give us a subscribe if that's the right terminology. Thanks again for listening. Reach out to us at the Numbers Game Podcast on Instagram, or connect with Nick, Marty, and I on LinkedIn, where we love to talk to our audience and friends and family of our businesses. Until next time,
game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.